So in this chapter, we'll be discussing about FRDI bill. That is the latest development. As of Jan 2018, there is a proposal to introduce FRDI. As of now, this is only a bill and not it passed in Parliament. So please update yourself with the latest developments because it's a key issue and causing a lot of anxiety among people, especially depositors. So before understanding what this FRDI is, you should first of all know what is meant by bailout. So what happens when a bank is in financial difficulty? That thought might have never occurred to you because banks are just like any other company. They have good days, they have bad days. And the basic business of bank is taking deposits from some people and lending it to others. So if the people who have taken loans don't repay, the bank will be having no money to repay to the depositors. So that is dangerous. So imagine a bank that has accepted deposits totaling 1,000 crores from various small depositors, fixed deposits, etc. And then it has lent this money to various people, companies, etc. as loans. And say out of this 10%, that is 100 crores has not come back. Okay, these companies are not paying back. This is what we discussed earlier as NPA. Okay, so now bank will get back only 900 crores. So then how is it going to repay the depositors whose total is 1,000 crores? Okay, so in practice, banks address this problem by postponing. That is, even though 100 crores is not coming back, banks keep getting fresh deposits every day. See, out of those, it can repay those depositors who want their money back. And also, not everyone wants their money back. So most of the people keep the money in the banking system itself in some form, like savings deposit or fixed deposit. So banks really do not run out of cash. So even with 10% NPA levels, they are going on. But this is not a long-term solution. Okay, banks with high levels of NPA a strain on the financial system. So earlier, when banks became financially weak due to high NPS, government used to rescue them by pumping in money. That is known as bailout. Bailout means giving financial assistance to a failing company like banks to save them from collapse. Of course, government pumping money means it's not their money, it is taxpayers' money. So it is a burden on the economy. Okay, because that money could have been spent productively elsewhere, or like building roads or other common public infrastructure. But still, the advantage here is you don't feel the pinch directly. In this context, you can also recall the discussion we had earlier on DICGC, that is Deposit Insurance Credit Guarantee Corporation. So all bank depositors will get deposit insurance up to 1 lakh. That means if a bank fails or shut down, you'll get money up to 1 lakh. So you have money of say a deposit of 50,000 and say that bank has failed, you'll get back your 50,000 as part of the DICGC insurance. But say you have a fixed deposit of 10 lakh and the bank fails, you get only 1 lakh. Okay, the other 9 lakhs will be gone. But still, knowing the above risk, people still continue to deposit money because there's a major reason for this. Public expect the government will intervene in case a bank fails, because this is a very politically sensitive issue. Most of the banks are public sector banks in India, and say a bank with crores of customers fails and they do not get their money back, you can imagine the commotion it will follow. No government will allow a public backlash like that, because that will make them unpopular. So even though DICGC insurance is only up to 1 lakh, people still deposit much more money than that with bank, with the confidence that government will always rescue a failing bank. It has happened in many cases in the past. Government has bailed out many banks. For example, Global Trust Bank has failed and RBI has merged it with OBC, Oriental Bank of Commerce, and none of the over 10 lakh depositors have suffered. So people expect this. In this context, let us now come to FRDI Bill. FRDI stands for Financial Resolution Deposit Insurance Bill. And the reason why this bill is generating so much anxiety is a clause in that bill called bail-in. Okay, till now we have seen what bailout is. Let us see what this bail-in is. Bail-in provision here means, say a bank is in financial distress, say due to high NPA. So instead of government stepping in, now the depositors will rescue the bank. How is this done? Say you have a fixed deposit of 10 lakh in a bank, and now the bank is in financial distress. It will now freeze your deposit to 5 lakhs. And the rest 5 lakhs will not be available to you for withdrawal. Instead, it will be converted to equity. Okay, so now instead of being a depositor, you become a shareholder of the bank. But you have to understand that because this bank is already in financial distress, the shares of the bank will not be that attractive. So you cannot sell them if you want, at least not at a good rate. So has this not happened before? So internationally, there were cases where this bail-in was applied. In 2013, Cyprus, that is a European country which had some financial crisis, invoked this bail-in provision. And in that example of Cyprus, say if you had a deposit of 1 lakh, what the Cyprus government did was converted 37.5%. That is 37,500 out of every 1 lakh into equity. 22.5% was held in reserve. that is as a buffer for possible conversion future. 30% was temporarily frozen. So this was done in other countries before. So this is proposed to introduce in India also now. And why are people worried? Because they will lose the deposits. So here let us see some arguments in favor and arguments in against FRDI bill. So arguments in favor is, one bank failing should not affect the entire financial system. So a bank in distress should solve its own problem internally with depositors' funds rather than depending on outsiders' funds like taxpayers' money. The another reason is India is a member of G20. We already discussed about G20 earlier. And G20 has decided on resolution of distress in financial institutions. And that G20 resolution has a provision for bail-in. It allows transfer, sale of assets without depositors' consent. And because India is a member of G20, it is bound on India to follow the resolutions. But there are also arguments against FRDA. The first reason is people trust banks, and that is why they deposit money with banks. Now, if they don't have that guarantee of getting money, getting back the money, they will lose faith in the banking system. Okay, people may rush to withdraw money from banks. People may be reluctant to deposit money in banks. So banks will not have money to lend to companies, and thereby the economy will get affected, and so on. Second reason is converting deposits into equity is totally risky, because deposits are safe investments while equity is risky. People put money in bank for safety. Banks just pay 4 to 6% on saving deposit, while investments in shares, mutual funds and other risky investments fetch above 15%. But still people forego that high return with the single aim of safety of money. Now if money you deposit in banks get converted into equity, and that too shares of a bank which itself is in financial distress, so it is basically a weak share. So the basic concept of safety is gone. Other reason is government has been assuring that they will not allow depositors to lose money. The government says that the bill will protect depositors' interest. G20 has developed countries which can afford this sort of bail-in. India is a developing country with a lot of small depositors, so bail-in provision will adversely impact the small depositors. So why risk people's money? See, that is the one of the questions asked. Bail-in effect means common people are bailing out rich corporates who have taken bank loans, misuse them and not repaying them. So why should people be made to suffer for that? And also bad loans in many cases are a result of bankers making careless, risky and even collusive sanctions. So why should public be made to suffer for that? So that is another argument. Another argument is close to 75% of deposits in India are with public sector banks. So it is widely believed that management at top level and their decisions are influenced by political leaders. So lending decisions are not always taken purely on merit. So against that background, there is always bound to be some risk of bad loans and risk of banks going into distress. So it's not an improbability that bank might go into distress, but a very likely possibility. So India's NPAs are 10 lakh crores as of September 2017. And please refer to Indradhanush plan that we discussed earlier, where government said it will infuse 70,000 crores. Well, banks has to raise 1.1 lakh crores. So total is around 2 lakh crores. That leaves a gap of 8 lakh crores. So if the government doesn't bail out, then that 8 lakh crore had to be borne by the depositors. Another argument is after introduction of bankruptcy code, banks have sufficient means of handling NPS, so this FRDI is not that much required. And also many of the G20 countries themselves are not implementing this, so why should India be rushing? So all these are arguments against introducing FRDI. There is also an order in which money will be paid in case bank is sold. The first priority will be for resolution costs, then secured creditors, wages, uninsured depositors, unsecured creditors, government dues, other debts dues, shareholders. So if deposits are converted into equity, those shareholders will be the last to get their money. Okay, so this is another reason against FRDI. So presently the current status is a parliamentary panel is reviewing the bill after it was tabled in Lok Sabha in August 2017. The bill is currently before a parliamentary committee, and the principal opposition party Congress has said on record that it will oppose this bill. So that is the current status.